Welcome to Spiedel's California Minute. I'm your host, Catherine Sedan. This week, we're covering important end-of-year tax-saving opportunities that your clients won't want to miss out on. Sign up for Spiedel's Federal and California Tax Update and get an update on important tax law changes that happen this year at both the federal and state levels. For details, go to Spiedel.com and click Webinars. With the passage of the One Big Beautiful Bill Act, everyone has been laser-focused on various federal year-end tax planning strategies. But tax professionals should not overlook the important California year-end tax planning strategies. First, consider the impact of lowering federal AGI. California keys some of its own deductions to federal and not California adjusted gross income, such as the 7.5% floor on medical expenses and the 2% floor on miscellaneous itemized deductions. These deductions are still allowed for California tax purposes and are claimed on Schedule CA. Because of this, all federal AGI reduction strategies, like maximizing retirement contributions, contributing to health savings accounts, and accelerating business expenses, can have a positive California effect. Next, remember that net operating losses are suspended for the 2025 and 2026 tax years unless the taxpayer is subject to the personal income tax and they have net business income or modified adjusted gross income of less than $1 million, and the corporation income tax if their business income subject to California taxation is less than $1 million. Taxpayers should consider accelerating expenses into the 2025 tax year to fall below these thresholds and still be able to claim net operating losses during the 2025 tax year. Key items to consider involve buying large-ticket depreciable items that qualify for bonus depreciation or the increased IRC Section 179 expense deduction. Although California does not conform to these provisions, if the California depreciation amount for 2025 can bring a taxpayer below the business income or modified AGI thresholds, it can have the double benefit of allowing taxpayers to claim the net operating loss deduction on their California return, as well as increasing their depreciation expenses on their federal return. Taxpayers that are planning to make a pass-through entity tax election on their 2025 tax return may want to consider making an additional payment toward their 2025 pass-through entity tax by December 31st, 2025. An additional tax payment in 2025 will increase the amount of the deduction the taxpayer can claim on their 2025 federal return, lowering the net income passed through to the owners on their federal Schedule K-1. It also reduces AGI, which can maximize certain California deductions. The option to make an additional payment in 2025 is only available to taxpayers that complied with the June 16th prepayment requirement. However, taxpayers may want to avoid making an additional payment if their 2025 qualified net income will be significantly lower than it was in 2024, and/or if fewer owners will consent to have the entity pay the tax on their behalf in 2025 than consented in 2024. And last, California law provides a 50% credit for contributions to the College Access Tax Credit Fund for businesses and individuals. When taking the College Access Tax Credit, the taxpayer cannot also claim a charitable contribution deduction on their California return for the amounts contributed. Also, the taxpayer has to reduce their federal charitable contribution deduction by the amount of the state credit claimed. We cover these and other California tax planning strategies in the December issue of Spiedel's California Tax Letter. For details on this monthly subscription, go to Spiedel.com and click Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.